Welcome to the daily update, where I'll go over the action in the market for Friday, May 2nd, and we'll see how things look for Monday, May 5th. Pretty positive day. There was positive reaction to the employment report. It was stronger than expected, and the market's been a little bit concerned about economic weakness, and so that fed into stocks going up. And we're seeing interest rates starting to go back up because they thought things were going to get weaker with the economy and the bond market. And it's actually holding up fairly well. We want to keep an eye on the whole employment situation area. If that really starts to go down, that could really suggest that we are going to go into a recession. For right now, the numbers are holding up. They're not robust. We're not seeing the huge upward move that we saw before, but we're not seeing really big declines either. And so the market liked that and ended up being a positive day. Okay, so right at the open, we had a gap higher open in reaction to the report. We were above R1 at 56.43. We got up above R2 at 56.82, and then we hit resistance at 5700. Now, this is not a technical level, but it's a psychological level, and we were battling 5,400, 5,300, 5,600. Now we're battling 5,700 again, and that's just about where things started to top out. Then we chopped between 5,700 and R2, and we closed slightly above R2. I forgot to put the above in there. We were up 1.47%. So we had another good week this past week. It's been crazy. It's been choppy. It's been really hard to pick out trends. And a lot of our indicators are giving us mixed signals along the way. But it's a real confused environment right now. And it's something that the stock market is not used to going through. And that's made it rather difficult. One thing that is kind of negative, though, is that we were below average with volume. Now, this is the most important economic report of the month, and it came out. It was friendly. You've got this FOMO, the fear of missing out. These are people that, oh my gosh, we're going back up. I need to get in right now. And that is happening, but you would expect volume to be above average, not below average. And so now we are positive in the short and intermediate term. There's always some concerns, and I'll go through some charts to show you that. But we're also showing some real improvement. But we're still negative in the long term since we're underneath the 200-day simple moving average. And inflation, that was what caused some problems on Thursday at first with GDP. Then later on, another inflation report came out and said, well, maybe things are okay after all. And so we're kind of going around with the whole inflation issue. Interest rates, they're going back up, but the market seems more orderly than where it was a couple weeks ago when the bond market was just going down fierce, then it was going back up fierce. It's stabilized, and the stock market seems to like that a little bit better. And then it's all about the tariffs and what's coming out of Washington, D.C., and what's going to happen. And for the most part, the it's kind of positive vibes are coming out for the time being right now, but that could change. April was a very difficult month, and we'll see if May is able to get things a little bit more under control and the market can have a little bit more conviction rather than it just lasting a day or two at a time. All right, so earnings from Apple and Amazon, they were not well received. Now, you could take this as positive from a market perspective. These are two huge companies that have a massive impact on the Nasdaq 100 and the S&P 500, and the fact that we were still up in spite of these stocks being under pressure, that's kind of a positive twist on it. And there's optimism around the trade with China after acknowledgement that China may be open to talks. It's like, we're not going to talk to you. Well, maybe now we will. This is part of the game that goes on back and forth, and the market like that. And then we've had 9 consecutive up days for the S&P. It wouldn't feel like that. There's been some pretty crazy days along the way, but this is a pretty good streak that we've been through here. We're dropping with the VIX. We're still above 20, but we're under 23 now, coming in at 22.68. And our short-term list is pretty long now. We have the usual ones that show that we have good short-term momentum, but now there's some additional ones suggesting that we might be a little overdone to the short-term side for right now. Plus, we're hitting some resistance, not only in the S&P, but in some other indexes that I'll point out. But we have the advanced decline ratio. It's starting to get extreme, and I'll show you charts of all these things. The Stoke RSI, Williams percent R, CCI 14 and 20, and stochastics. Those are usually on this list, even when we're positive, and they start to get extreme. I treat this, depending on the bigger picture context, which is tending to be more negative now, but this is also showing good short-term momentum at the same time. But then we have some other ones in the short term, like the rate of change going back 10 periods and 20 periods. Those are starting to get extreme. Those aren't usually on this list. The slope oscillator is a short-term momentum oscillator. It's getting extreme. The boom indicator, we're way above the 20 period moving average, and then the 20 period moving average study. And again, I'll show you all this stuff, but there's additional things on this list that are causing some concern that, okay, this euphoria might be due for at least a rest in the short term. Then in the intermediate term, we're looking a lot better, but we're still seeing kind of a long list here. The CMB composite, this is a momentum oscillator, as is the Connors RSI. The TTM squeeze, it's been extreme for a few days now. We have the McClellan oscillator, both for the S&P and NYSE, looking extreme. The PMO studies, and then the bullish percent index for both the S&P and the Nasdaq 100, and our 10-day average or advanced decline study, as well as the ultimate oscillator is extreme. A little bit longer, some things that aren't typically on this list that are starting to come on the list. No real change to the overall scenario. The Fed is still kind of their current scenario is that they're worried about economic weakness and inflation going up. And now we'll have to see. If we see more economic weakness, there could be a chance that they might come in and cut rates at some point to try to stimulate the economy, which that would make cutting rates switch over to a more negative context. Why are they cutting rates? To stimulate an economy that's already doing well? That's what we saw last fall. If they come in and cut rates because employment's going down, the growth in the economy is going down, that changes the context and that turns it more negative. Okay, the dollar was down, interest rates were up. We're at 4.32% after Friday, where we had been at 4.23% after Thursday. And this is kind of strange. We've been zipping around a little bit here for sentiment. We're still negative at 43, where after Thursday we actually had a reading at 47, but then that quickly went back down. This might be an erroneous number, but nonetheless, we're above that 25 level and sentiment has been improving. And we're back to being even now with the 10-year to the 3 month. The yield is the same. We're not inverted. We're not regular. We're back to they both are the same for the time being. This is kind of a big change, though. The ADX that we use to determine the condition of our trend, that's been the holdout. Even as we were coming back up, this was still negative. Well, now we're finally switching over to this being positive. We have the green line crossing above the red line, and that is showing an improvement, but it's still weakening. We haven't turned up with the ADX yet. It's still below its moving average. So this new positive trend is not real strong, at least yet. Now it could build up some strength, but according to this, we're still in a weaker state now because we're above 20. That means we're trending. That's just a static number to suggest when we're above 20, we're trending. When we're below 20, we're not trending. And with the update, our bias is positive, and now I'm changing our momentum to positive. It had been mixed to positive. We're looking pretty good right now, but there are some concerns. Okay, we had the non-farm payrolls, which came in at 177,000, much more than the 130,000 that were expected. Now, another thing to pay attention to, when we had this report a month ago, it told us they had 228,000 jobs. That got revised down to 185,000 jobs. That's not good. So coming in above expectations, that's good. This is not good. So that's kind of a mixed picture there. We look at the private payrolls. also greater than expected, 167,000, more than 125,000 that was expected. We also saw the number from a month ago revised down from 209,000 to 170,000. Average hourly earnings at 0.2%. That's not inflationary because they expected it to be up 0.3%, which is what we saw last time. So that was lower than expected. The unemployment rate stayed the same. We're at 4.2%, which is what we saw last time too. The average work week, 34.3, a little bit up from the 34.2 they had expected, but also it came in at 34.3 last time. And then kind of another report that came out that doesn't really have an impact. Factory orders up 4.3%, more than the 4.1% they had expected. Last time it was up 0.5%. All right, so here's some charts. I don't show the jobless charts because it has the COVID stuff in there and it makes the chart pretty much useless. But this is just the unemployment rate where we're kind of humming along, going sideways, slightly above 4%, coming in at 4.2%. And then I have to move this around here. Then the average hourly earnings on a year-over-year basis, those are actually declining when you look at this year over year. It's coming down a little bit. And that's not inflationary, but that's kind of sucks if, for your job, if your wages are actually going down. And then the payroll change, it was down from the previous reading, but still a lot higher than what they were expecting. Then this kind of puts it all together. Thursday's data gave us the red line, which are the initial jobless claims. That's coming up here, but we're kind of at the higher end of this range that we've been in. If this really breaks to the upside, that's going to be a warning sign. Also, with continuing claims, which we see here in blue, also breaking out a little bit. It's been chopping along pretty much sideways for quite a while. And now the new unemployment rate, which is at 4.2%, just to put all these together. And factory orders did see an increase on a year-over-year basis. Those are going up, and that shows economic health. Okay, then we have buybacks. That is seen as something that is positive when they take place. That's usually when we're going up. That's where you see the blue. When we're going down, that's when you don't see buybacks happening here. And so this is what's been happening so far in 2025. I get 2250. Okay, well, I guess we already have that. I'm not the only one that gets the dates wrong. Oh, I guess this is a not a year, it's a level. But as we've been going down, companies haven't been willing to come in and buy back their own stock. Now that we're looking a little better, we'll see if this changes to blue and they actually come in and say, okay, yeah, we're going to buy back some of our stock. That's seen as something positive for the market. And then maybe we should call it sell in June. There's this cliche in the stock market, sell in May and go away. April is usually one of the stronger months. We were down less than 1% once we got done with April, but May tends to be pretty good. Now, 2019, not so much, but when you go back to 2015, so more recently, over the last 10 years, we're up 90% of the time in May with a median return of 1.1% and an average return of 0.9%. And then looking at the ISM manufacturing, which came out, and this is a little bit of a concern because we're under 50 with the overall rating. And that's the yellow or gold line that you see here, which is going down. Usually, if the market's going up, this is going up. If this is going down, the market's going down. So they're kind of diverging from each other a little bit here. And we're hoping that maybe this yellow line will turn and start to go back up. And then looking at the forward PE, and I also go over this in the weekend videos with the intermarket analysis. We're a little bit above 20, but according to this chart, when you look at the forward PE ratio for the S&P, we're at about 20. It's when we get above 20, that's when we're considered to be expensive. But we can stay expensive for quite a while. Where if you look at the equal weight version of the S&P, it's coming in at around a forward PE of 16. It's the Magnificent Seven stocks and the really big stocks that drive the PE ratio higher. Gold, which has been coming down, it was really going up as stocks were going down. Now it's coming down as stocks have been going back up. And then stocks are about 25% priced for a recession. I don't know how they do this, but they're just coming up with the idea that, at least according to the stock market, there's a 25% chance that we might go into a recession. Okay, fine. Then the history of U.S. tariffs, up until really it was right down in the early 1900s. That's when the income tax was passed under Woodrow Wilson. But this is how the U.S. used to bring in most of its money back in the 1800s. And then after World War II, we started doing it other ways by, oh, this income tax that's only going to last for a little while. Well, we're just going to keep doing it, and then we're going to ask for more. And so the tariffs have really become less of a way of doing things. Well, that's all changing now. So it's really going up with the tariffs and coming down. And so it's not like we're trying anything necessarily new. It's new to all of us because we didn't grow up in this kind of an environment. But if you look at it back in US history, this has been done before. We didn't used to have an income tax. And so how the government brought in their money was through tariffs by taxing things that were coming into the country. And that's the idea, at least from what I'm gathering, that the Trump administration is trying to do. Not focus so much on income taxes, but focus more on tariffs. But it's a bumpy road, and everybody has an opinion, but nobody really knows how all of this is going to end up working out. Okay, and then we're getting back close to 100,000 with Bitcoin. We'll have to see. That seems to be a difficult level for Bitcoin. I just bring it up because it was one of the charts that's here, but it's been bouncing back up lately too. And then still only slightly less magnificent. Looking here, extreme excitement is over, but the Magnificent Seven are keeping up with the market. So not doing as good as they were before, but still the real backbone of the Nasdaq 100 and the S&P 500. Okay, here's our chart where we did gap up above R1. We made it up to R2, and then it looked like, okay, we're gonna have a little bit of trouble there. We just chopped along sideways, but then we went up, and this is 5,700 right here. Got near that, came back down to R2, tried to go up to 5,700 again, couldn't break through it, and then we ended up closing down just a little bit above R2. Intraday chart, not much of a change after the market closed as things get set to close over the weekend. Things were pretty quiet before because everybody was waiting for the employment report to come out, and that's when all the reaction really took place. This is still showing an improvement with the blue line above the red line, an intraday chart of growth to value. That's what we want to see. And typically, when we're going up, we'll see the blue line above the red line. When we're going down, that's when we see the blue line below the red line. Also looking pretty good here with our S&P growth to value ratio. We want this to continue going up. That means that growth is starting to outperform value on an intraday basis. And then I'm going to start including this. Every day I put this on the YouTube community tab, and those are the pivot points for the next day. And I'm surprised more people don't use these because these are pretty stinking accurate. If you go all the way back to the intraday chart, right here. This is where I get these points from. They're pre-calculated. So these lines are already on here. Now, I also put one up that's a daily version. I'm just going to start putting this in the video now with the intraday version. Those are what I found to be the most reliable. Now, the chart looks a little bit different because I have to use different software to do this. But again, this is just the chart that I went through. This is a 10-minute candlestick chart. But we already know these levels already for Monday. And in the market, they're the algorithms that are on the stock exchanges, all these numbers, they're already programmed in to what's going to happen on Monday. And that's why we see reaction around these different levels. So this is a very useful tool, and we don't get a lot of things before they actually happen that the market will end up using. And so I feel that I want to include this more than I have been. All right, end of day, growth was up more than value for the large caps, mid caps, and small caps. So it was a pretty good day for growth. We are improving with our S&P end of day chart, excuse me, small cap end of day chart growth to value ratio. We're improving with the mid cap growth to value ratio, and we're improving with the S&P growth to value. We're still in a downtrend here, but we're breaking further above both of these moving averages. Can this continue? We want this to go up if we're more positive on the market. And we're improving. We're coming back up into the rainbow with this growth to value ratio here. And this is the large cap growth ETF where we finally were able to get back above the 50-day moving average. We're trying to come back up to the 200-day moving average, but we haven't quite reached that. That may provide overhead resistance if we see more follow through to the upside here. Then looking at discretionary to staples, improving, but still negative. It's in a downtrend. And we're in a downtrend when we look at discretionary by itself. Staples have been holding up a little bit better. That's why this ratio has been under pressure. But lately, discretionary is coming back up, but it has a lot of damage that it's trying to repair. So we look at the regular discretionary to staples ratio, and we're seeing a pattern through all these charts in a downtrend, which means the market's been getting more defensive, but trying to improve. And we see that with the equal weight. That's the chart I just showed you. We see that with the tech versus utilities ratio, the biotech healthcare ratio, and the hotels versus utilities ratio. Improving, but still the bigger picture is that the market has been getting more defensive. Then we look at some what are called bellwethers of the US economy. Semiconductors under pressure but improving. Home builders, the same thing. Transports, the same thing. Retail, as well as regional banks. We want these to do better. If these areas are doing better, that's more healthy for the stock market. And here's retail with a ratio of the retail to the SPY. When this is going down the way it has been now, that means retail's underperforming. Then this is retail by itself. It's in a downtrend, trying to get back above its 50-day moving average, and we're still climbing above 50 with the RSI. So things are improving, but haven't switched over to positive yet with retail. Then this is, it's really hard to see here. You can't see it because the lines are on top of each other. You have to look over here on the left where the green line is at 24.47. The red line is at 24.31. 47 is higher than 31. So we're actually crossing positive here with the intermediate term trend. This is a little easier to see, but still a spaghetti mess here where we're seeing the green line crossing above the red line with the short term. And we're still below average with volume. And even though it was a very important day, we actually declined with volume. We're dropping under 24, under 23 now with the VIX. That's good. We want this to come back down. We're still apprehensive until the VIX actually drops below 20 if we're able to do that. And when the VIX is coming down, the VIX of the VIX is also declining. And the momentum of the VIX continues to be down. That's positive. We're going down with this fear gauge and this other fear gauge. Fear's been coming out of the market over the last few sessions. We're going up with the risk on versus risk off ratio. That's what we want if we're more positive. And we're improving here with the high beta to low beta ratio. High beta, this is Apple, Amazon, Netflix, Google, the stocks that outperform to the upside. And this is like a risk on to risk off ratio as well. Where the low beta stocks, those are the safer stocks. Well, when we were really coming down, this ratio was coming down. Now this ratio is starting to go back up and it's improving. We're actually seeing a little bit of hedging here in the daily chart with the equity put call ratio. We're going up with the 5-day chart, but we're still going down with the 10-day chart. Not sure we're getting a lot of insight there. Still seeing the volatility risk premium is quite low. All right, we are positive with the advanced decline line. We're above the moving average and going up based on price and volume. This is one of the extreme readings, the advancers decliners over 10 days. This is set up like an oscillator, and when we get above this 100 level, doesn't mean we need to stop, but we just start watching this closer now. Because when we top out and start coming down, it doesn't mean that we're going to necessarily reverse. But it can mean that. There have been times when we saw this spike up and then we saw more of a significant down move. We're starting to get extreme in the short term with the advanced decline ratio based on 19 periods. We're still positive and going up with the 39-day version of it. And this is also the 19-day advanced decline ratio, starting to get extreme here. Not extreme, but really showing an improvement here when we look at this based on volume. And now we're seeing some improvement here with the new highs, new lows. The big concern had been that the moving averages were going up, not because we're seeing more green, but because we were seeing less red. Now we're starting to see some more green. We need to see more follow through with this for the internals to actually continue to improve. We're positive with smart money indicator number one. We're above the advancing moving average and going up. We're positive now. We actually switched to negative after Thursday, but we're positive with the chicken money flow. This is smart money indicator number two. This is still a concern though. We didn't turn up with the chicken oscillator. And if you look at these crazy, really long numbers here, we're just a little bit negative with this. So it's not quite a confirmation. It's best when all of our three smart money indicators are saying the same thing at the same time. And it's kind of surprising that this actually went down when we had a fairly positive day. We came down with the vortex with the green line, but the green line's still above the red line. So this is positive. And I haven't shown much of the advanced decline lines lately, a lot of the studies, because they haven't been doing much. We were just chopping along sideways. But now we're starting to improve. In fact, on a cumulative basis, this is actually quite positive because we're actually coming out and breaking out to a new all-time high here. Now we still have quite a ways to go to get back to the all-time high for the S&P, but the fact that this is really improving is encouraging. We're also improving, but not back to the previous high yet based on volume. And this is also a longer term internal measure. The highs and lows over a 10-day period of time for the S&P were above 50 and going up. And so that's showing longer term strength coming back into the S&P. We're looking much better with our advanced decline line studies. We're above the moving averages when we look at the NYSE common stock, the S&P mid caps, and even the small caps are starting to show some improvement there. And then we look at the broad market here. This is the cumulative NYSE advanced decline line. This is also breaking out to a new high. Now we're not at a new high for the NYSE. This is the S&P up here, but this is showing some more improvement. And we're also showing quite a bit of improvement here, not quite breaking out yet with our regular NYSE advanced decline line and this other NYSE advanced decline line. We were just starting to go into a downtrend with this advanced decline line. Well, if we can keep going up, we may negate this death cross here and it actually could turn back into a golden cross. And then we look at it just based on common stock, looking a lot better here based on price and volume, but not at new highs. This is a broader measure market here, 5-period moving average across the Amex, NASDAQ, and NYSE. We're finally coming back and starting to cross above zero with this indicator. So much improvement after it had been quite negative. Now, we're a little concerned here with those stocks in the S&P above their 20-period moving averages. When we get above 70, that's this next chart. That's when we say, uh-oh, we better watch this. When we get above 80, that's when, okay, we better really watch this. Right now, we have 86.6% of stocks in the S&P above their 20-period moving average. When it gets to that high of a reading, a lot of times that can point to some short-term exhaustion. And here we're also coming up to a pretty high reading as well. Now, we'll just see because there is some overhead resistance that I'll go through, but we're looking positive in the bigger picture because for the first time in quite a while, we're crossing back above 50 with those stocks above their 50-period moving average. We're improving, but still below 50 with the 100-period moving average study, also improving, but still below 50 with the 200-period moving average study. So in the short term, we're back above the 50-day moving average. We're coming right up to this previous pivot point here, and that's right at about 5,700, and that's just about where we topped out. So this dashed line here is overhead resistance. Now, if we are able to break above this, we might be able to bump into the 200-day moving average, which is likely to also provide overhead resistance. Now, when we just look at Friday's session, the advanced decline ratio, it was quite positive, and we're getting an extreme reading. But this is just one day compared to the previous day here. And we are improving with the 20, 50, and 200-period moving averages for the S&P. These are the usual indicators in the short term that when we're showing good short-term momentum, we get pegged at the top with these. This first one is the Stochk RSI. We're also extreme with the Williams percent R, the CCI 14, and the CCI 20. Now, the CCI here, this is Commodity Channel Index. It was created for commodities, but I use it for stocks. These still have a little bit more room to run before they're getting really extreme. We just call them extreme when they're coming in over 100 here. And I have a kind of a shorter term and a little bit longer term. Now, when we look at the short-term stochastic, we're getting extreme. We're starting to roll over and we're extreme with the intermediate short term, but we're still improving and not extreme with the long short term. The reason I say it that way is this is a subdivision of the short-term time frame. We are positive with the force index. We're seeing a lot of improvement here with the short-term trend as measured by the double and triple exponential moving averages. We're above the green line and blue line and going up there. We're above the 20 period simple and exponential moving averages, and the lines are starting to turn back up. So that's showing an improvement there. But we're possibly looking extreme when we go back over the rate of change over 10 periods. We're way above this red line. And when we go out 20 periods, we saw a big move up here. Not really big extreme. It becomes very extreme if we go above the red line, but we start to notice this when we go above the blue line. We are looking better here with our standard deviations chart. We're in the +2 channel, and the midpoint is starting to turn back up as well. So that's also improving. And we're still above zero with the balance of power. We're showing improvement here with the bow tie. And the longer we can stay above these lines, what eventually we want to see happen is we want this fluorescent green line to actually be on top and continue to go up. That's when we're in a more established uptrend here. So this is improving, but it hasn't switched over to full-blown positive. We're getting really extreme here with the CMB composite. We usually don't see such high readings as what we're seeing right now. We don't get a lot of extreme readings with the Connors RSI, but we're getting one right now as well. And we're brown. This is more switching from negative to positive with the no go system. And we're looking better. We're seeing the with the highest high, lowest low value. We're above the midpoint and going up. The blue line, which is the highest high value, that's starting to go back up. And we're seeing the red line, the lowest low value, it's also starting to go back up. Now, this is a change. This is one of the newer indicators. It's called the Landry Light. When we were going down, and the longer we go down, the bigger these lines become. Actually, we've switched over to positive. It's kind of hard to see, but we've gone from red to green here. And so this is picking up that the more intermediate term trend has now switched back to positive. And we're getting really extreme here with the TTM squeeze. And just because this is a longer term chart to give it more context here, we haven't seen this high of a reading on the values that we're seeing on this chart. So that's a little bit of a concern there. We are improving with the intermediate term trend. We're starting to turn up with the blue line and the red line, and we're above both. And we're above the 50 period simple and exponential moving averages. So that's why we're back to positive now in the intermediate term. And we're actually coming in and we closed a little bit above the 100 period exponential moving average. So that's encouraging. Can we stay above this? Are we going to go up and test the 100 period simple moving average? And then here's the whole spaghetti tree here. I call it a moving average tree, but it's been all crazy all over the place lately. And we're far away from the 20 period moving average as measured by the boom indicator. We're getting way far away, but we're not too far away, but we're looking better here with the 50 period moving average study with the boom indicator. We're trying to see if we can get back up to zero to get above the 200-day moving average. And here's the anchored moving averages here. It was encouraging when we were able to get slightly above this anchored moving average going back to the all-time high set in February. Well, then we were able to get above this other anchored moving average going back to the low set a year ago. That's encouraging. Now we're dealing with another low here, the orange line. We're just a little bit below that right now. So if we can slice through some of these other lines here, that'll be more positive. And we're getting closer to the 200-day moving average. We're now 1.03% below the 200-day moving average. And we're starting to move kind of quick again here. And the standard deviation is picking that up. It measures speed, not direction. We actually came down a little bit with the ease of movement, but we're still above zero. It's positive. And coming up a little bit here with the Arun, but it's still below zero. It hasn't picked up a lot of this positive action that we've been seeing. We're starting to get extreme with the McClellan oscillator for the S&P. We're above 60. We could still go higher than this. But other times when we topped out and started to come down, you can see that sometimes it just led to some sideways action. There are other times when this actually led to a reversal. So we just want to be aware of that. But anytime we're above zero with the McClellan oscillator, we're positive with the summation index. So we're going up based on price and volume. This is showing a lot of improvement. We're also starting to get extreme with the NYSE McClellan oscillator. We're above this 80 level here. And again, you see the other time we had a high reading, we still had a little bit of room to run before we went up. And then we had that big gap down. I think this is the deep seek gap that we saw here. But since we're above zero, we're going up with the summation index based on price and volume for the NYSE. We're turning back up. This actually had gone negative on Wednesday and Thursday. It's turning back positive after Friday with the Swindon trading oscillator based on price, and we're just barely turning up here based on volume. Momentum is positive with the PMO. We're also positive based on price and volume. We're starting to get extreme with the PMOs that are rising. These are all the PMOs inside of the S&P 500. We're also extreme with the buy signals, but we are improving with those PMOs that are above zero. We're positive with the Elder's Impulse system for the S&P, and we're positive with the parabolic SAR since the dots are underneath. We're possibly getting extreme here with the slope oscillator. This is a pretty high reading after being very negative. This is a short-term oscillator. It's a little more touchy. We're finally crossing back above the midpoint with the MACD. This is short to somewhat intermediate term. And so this is looking quite a bit better here. So you can see the slope, it's pretty extreme right now. Where the other short-term oscillator, the TSI, it's just crossing back above the midpoint. Where we're getting back above the midpoint with the MACD, we're also positive with the PMO and PPO. Long-term, the TRIX and KST, those are also positive. And we're positive here with the Copic curve. We're not quite at an extreme reading, so I didn't include the longer chart here. We're seeing a bit of an improvement, but we're kind of in this more neutral area. But the context is with the Sean trend meter that we are improving. We're also looking better here with the money flow, and we're starting to get extreme with the ultimate oscillator. We're above the moving average with on-balance volume, and now the moving average continues to turn up. That's positive. We're above 50 and going up with the intermediate term RSI and the short term RSI. And we're starting to possibly get extreme here with the S&P bullish percent index. Now it could go above the 70 level, but this is when we really start to pay more attention to it. We're also crossing back above 50 with the NYSE bullish percent index, and we're also above this extreme level with the NASDAQ 100 bullish percent index. So we're seeing some overbought conditions that might cause some issues here. And the mass index, since we were going up when this was triggered, to me, this should be signaling that we'll have a downward move. We'll have to see if it ends up playing out that way or not. We're still working off of a Pring bottom Fisher buy signal, but that was generated back in April, and that ended up being a pretty good signal when we really started coming up after this gyration that was going on. But the further we get away from this, the more irrelevant it becomes. Then this is kind of critical. And these are Fibonacci retracements. And just a little over a year ago, we had a pretty downward move in April 2024. This was the bottom over here on the left. And then we came up out of that, and then we just kind of made our way through 2024. We set the all-time high in February 2025, and then we were just busting through. These levels tried to offer some support, but really weren't doing it. We came all the way down here to almost a full retracement to the climb that we saw going back a year ago, April 2024. Well, and we've been coming back up. We got above the 38.2%, we got above the 50%, but look at where we're at right now. We're bumping into the 61.8% retracement level. When you combine this with other overhead resistance that we're seeing, we need to watch that to see if this is going to turn into something, because the market in the short term's overbought. We're hitting resistance. This is one of those resistance points. So we can't just assume we're just going to keep going to the upside. We could, but we just want to watch these things a little bit more closely, because this would be a logical place when you combine it with some other things that we might start to see a pullback. Plus, after having 9 up days in a row, I mean, okay, at some point, people are going to want to come in and start taking profits. Now, this is positive and it's longer term. We were able to close above the pivot point here on the weekly chart for the S&P. 55.75 was this P point here, pivot, and we were above that, 56.86. So that is positive longer term. Then we are positive when you measure the chart using different ways of looking at charts. The Heiken Ashi is positive. We're positive with the Kagi chart. It's black and pointing up. We're positive with the Renko chart with the open blocks. We're positive with the 3-line break. We're also positive with the point and figure, and we're starting to break out above this downward sloping trend line here. And we had another X drawn in, coming right up to 5,700 for the S&P. And this is still suggesting a triple top breakout because we were in this boxed area and then we tried three times to get out. The third time, that's the triple. This is breaking out here. And so this chart is also showing things improving quite a bit. Long term, we're also improving with the 150 and 200 period moving averages. We're still positive in the short term. We switched back to positive in the long term for the NASDAQ 100, but intermediate term, that's where the market's trying to recover on the different indexes, but not quite there yet. And then bonds are now negative across the board based on price, commodities, and the dollar are all negative, where stocks are showing some improvement. All of the sectors ended up being positive, and this is fairly encouraging. Even staples were up, but they were up the least. That's defensive. Utilities were also one of the underperforming areas, as was real estate and healthcare and energy. These are the areas that tend to do better when the market's running into problems. We like that the financials are doing good. Tech, it wasn't at the top, but it still did good. We like that discretionary and communication are doing good. These are the three big growth areas. Even though they weren't outperformers, they still had a pretty good day. And so a lot of just one area here with the dollar, it went back below 100, but then I believe it got back above 100 by the time it closed. But a lot of positive things happened here with the BPI cross above 70 with the materials, the industrials. These are more economically driven. And when the report came in stronger than expected, it's like the cyclical stock said, oh, okay, maybe we can go up after all. Maybe the economy is going to hold up for right now. And the financials had a BPI cross above 70. Communication, that's growth, came back above 50. You had the NASDAQ, which went above 17.8, 17.9, got above 18,000. The S&P got above, it got above 5,700, but we closed below it. And we had this BPI cross above 70, which I just got done showing you here. And even Canada got in the act here. And the Dow was able to get back above 41,000. Okay, now as far as another alternative for measuring inflation, this is called Truflation. This has actually been going down, and we're at 1.37%. What this is coming up for inflation. Okay, well, oh, I hit the wrong button. Sorry about that. And then we look at the S&P weighted version and compare it with the equal weight. They're both doing okay. Now, when the bar chart is above the red line, that means that the S&P weighted version is outperforming slightly, and that's what we want in a more positive environment. And we're coming right back up to the 200-day moving average with the Dow. It's still in a downtrend, but this could be providing overhead resistance. As I mentioned, overhead resistance, keep that tucked in the back of your mind. We've already seen it on the S&P. Now we're seeing it here on the Dow. I wouldn't count this. This is positive with the Elder's Impulse system for the diamonds for the Dow. And we're not seeing resistance here with the NASDAQ. We are improving. We're above the 50-period moving average. We're above this pivot point here, but we are in a downtrend with the NASDAQ. However, we're positive with the NASDAQ with the Elder's Impulse system. Here's another. NASDAQ 100, S&P 500, closely related to each other. The NASDAQ 100 is the growth part of the S&P 500, coming up to the 200-day moving average, another area of overhead resistance. But we're still positive with the Qs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is positive. Here, showing the Qs coming right up to the 200-day moving average. Now, this is actually looking pretty positive. This is a weekly chart. And what we're seeing here is a series of higher highs and higher lows. And when we finally bottomed here, it looks like, and we've been coming back up, this is longer term. This is a weekly chart. And this is showing longer term things improving. But small caps, another overhead resistance, came up to their 50-day moving average and just stopped right there. Still negative though. This previous one is the S&P 600 small caps. This is the Russell 2000 small caps, but still negative, but improving. We're above 50 with the RSI, and we're showing short-term momentum is positive. And also going from neutral to positive with the small caps with the Elder's Impulse system. Now, we did get above this moving average with the mid caps. So we're not really seeing much overhead resistance there. We're turning from neutral to positive with the mid caps. We're above the 50-period moving average with the Wilshire 5000. And we're not up to the 200-day moving average. And we're above the 50-day here with the total U.S. stock ETF. So these are just showing some improvement. here. We're above the 50-day moving average again with the financial sector. That's good, and the trend is still positive. The FANG index had a death cross here, but ever since it created the death cross, it's been going up. These are the really big stocks. This is also improving. The staples to tech ratio is going down. That means tech is outperforming staples, but in the bigger picture, the uptrend shows that staples have been outperforming. This is improving, but not real positive. This is another ratio, the semiconductors to tech. Earlier in 2024, when this was really going up, that means the semis were outperforming tech. And tech was doing good all by itself. The semis were just doing better. Then we topped out over the summer, and then this ratio started to come down. But the S&P was still going up. It's just other areas were coming in and driving the index higher. So it doesn't mean the end of the world here, but we would like this ratio to really go up because this ratio has really been going down. Apple in a downtrend, down 3.74%, not really well received with their earnings there. Amazon virtually unchanged, trying to deal with its 50-day moving average and in a downtrend. Microsoft really is still in a downtrend, but it was up 2.32%. Google in a downtrend as well. Nvidia in a downtrend, up 2.59%. Meta up over its 50-day moving average, just closely getting to a death cross here, up 4.34%. Trying to get back up to its 200-day moving average with Tesla, but it's in a downtrend. Netflix, another day, another new all-time high. Probably the best looking stock, and it has been. It just keeps going up here. It was up over 2% again on Friday. We are seeing a pretty strong correlation in the short term between US and world stocks. Longer term, the relationship is there, but it's been flattening out. Oil continues to drop. We're getting into the high 50s rather than being in the 60s. And this is a weekly chart. I'll also go through this in the weekly, probably the intermarket analysis video, where we're seeing this trend line here, the gold to SPY ratio. We topped out here, came down, topped out again. Then the trend line, we came right up to this trend line, and now we've been coming down as stocks have been outperforming gold over the past week or so. The dollar just barely above 100, but still in a downtrend. And we really shot back up with the 10-year yield. But for the most part, bonds have been stabilizing after we saw this big move down and then this massive move up. We're just seeing more normal activity right now, but that could always change. And we came down with the 10-year based on price. We're back to zero. The 10-year and the 3-month are giving us the same yield. So the yield curve is right at even currently. We are improving here with our growth to value ratios, the Qs to S&P. This is not improving that much. Discretionary to the SPY here, we want this to go up, but we are improving when we compare large cap growth to value. And we're above the moving average with the large caps, mid caps, and small caps. This could be positive for the market if it can follow through. And we're coming down with the staples to S&P ratio. Before I showed staples to tech, this is staples to the S&P 500. When this is coming down, that is more positive. So what's our outlook for Monday? We are positive in the short and intermediate term for the S&P. We're still below the 200-day moving average, so we are negative there. We're going to get the S&P Global U.S. Services PMI. That's not really impacting all that much. But the ISM services, that's big. And if that comes in under 50, that could create a problem. Above 50 shows expansion, below 50 shows contraction. And then anything geopolitical, whether it has to do with the wars that are going on or what comes out of the White House, some new AI announcement over the weekend, that can have an impact. We'll just have to see how things go there. Here is the economic calendar for the upcoming week, where we'll get the ISM on Monday, not much on Tuesday, trade balance, which is always negative. The Fed is going to be meeting, and they're going to make their announcement on Wednesday. They'll also have a press conference. They're not going to change rates, but they have stuff they're going to say. And then we're going to get initial jobless claims on Thursday, and we have nothing on Friday. This is also showing what is coming up in the upcoming week. Seasonally for May 5th, we're neutral to negative. So no real advantage there. And then for May, we tend to be positive. And this is the last time I'll show this chart in the daily video. I'm going to switch this over to the weekly video. If you go back to 1950, the past 20 years, the past 10 years, post-election year, May tends to be positive there. This I got from the Stock Traders Almanac, and this is actually a year old now. That's the red line that you see. It was 2024. The reason I'm bringing this up is this is NYSE volume, where typically, as you would expect, July and August, that's where we see volume really going down. People are going on vacation. Things are usually more laid back in the summer. So that's usually when we see volume going down here. And we also see it for the NASDAQ as well over the summer months. Not a real stretch to see why that happens. Okay, now we are still negative, but improving with our long-term growth to value ratio for the S&P, as well as the discretionary to staples ratio. We need those to turn back positive. The moving average studies. Now we're extreme in the short term. We're going above 50 with the 50-period moving average. We're still below 50 with the 100 and 200 period moving average studies. And our long-term special K, which I'll show in the deep dive video, that's still negative, but it is turning up. Then positive, and again, it depends on how you want to interpret this. Accumulation distribution is positive, as is the Chaikin money flow. Technically, the Chaikin oscillator is now negative. It's below its moving average. But we're still positive, possibly looking extreme with the McClellan oscillator for the S&P and NYSE, and the summation indexes are positive. We're possibly getting extreme with the S&P and NASDAQ 100 bullish percent indexes, but they're positive. Parabolic SAR is positive. Momentum is positive. The short-term slope oscillator, that's a little bit of a concern. Ease of movement, money flow, and ultimate oscillator, which is now extreme, but they're still positive. Swell and trending oscillator, which for Friday's session, it was on the negative side. After Friday's session, it's back here on the positive side. The vortex is positive, even though the green line declined, and the financial sector is positive, as well as the momentum for the NASDAQ 100. And then we have this mass index thing here. And then the spring bottom fisher. Again, we're kind of getting far away from that. So I don't know if I'd put too much into that now. So the conclusion, we are positive in the short term and improving, but we're overbought. We are breaking above this recent range. Now we're dealing with 5,700, but are we too overextended? 10 days in a row of up days, somebody's going to want to come in and do some selling at some point. And we are positive now in the intermediate term and showing improvement there, but we're still negative in the long term since we're below the 200-day simple moving average and we're in a downtrend here. Thank you. I really hope you found this helpful. Have a great weekend, and I will talk to you in the next video.